But talking about what Powell had to say, well, he reinforced the position of the Fed that they're not ready to start cutting rates as yet. They will work towards that 2% mark in terms of inflation, and only then they are probably looking at a rate cut later in the year, but not in a rush to do that. Listen in.
While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all.
Okay, so that's the commentary coming in from the Fed Chair Jerome Powell. So let's take it forward and discuss it further with Cameron Brandt. He's, of course, joining us as the Director of Research at EPFR Global. Hi, Cameron. Thanks so much for making time and speaking with us. What's your key takeaway from the commentary that we heard from the Fed Chair yesterday? What was different?
There wasn't actually much that was different. Except that Jerome did say or send a very strong signal that the interest rates have peaked, even if they're not going to go down as quickly as markets hoped coming into this year. It was testimony that didn't throw any nasty surprises in the mix. So markets had pretty much assumed what the chairman actually said. So it was something of a strong orange or green light to keep moving in the direction people already were.
Outlook then in terms of what the trajectory could be for inflation, and how have you read into as well the jobless claims data that came in, Cameron?
I've certainly been among those who felt that it was going to take a bit longer than the market consensus at the end of last year to get the Fed to the point where it was comfortable actually cutting. It's actually going to be quite difficult, I think, especially if the Fed does sort of stay data-driven. We're certainly starting to pick up sort of real optimism at the corporate level and talk of increased investment and pretty rosy assumptions for demand through the rest of the year. And if that happens, that's going to sort of generate some price pressures of its own. So I certainly expect a cut. But I think it might easily be in the second half of the year.
You know, that's exactly the talk of the town this morning or since last evening, right, Cameron? When and how many? I mean, Neil Kashkari saying that there are going to be 2 rate cuts at most this year. You've got the Minneapolis Fed president saying that maybe 1 or 2 rate cuts as well. What do you think the market is pricing in right now?
I think the market is pricing is retreating from 3 to 2. But it's the kind of retreat that's not under huge pressure. There's certainly a very sunny consensus that whatever the Fed does, we're going to have the soft landing. The labor market is softening, but not in any hard way. Consumption is holding up. So at least for the moment, I think we're going to sort of see a glass half full approach to investing, especially on the equity side.
Full approach. But Cameron, since we have you with us, talk to us about what the latest flows picture has been into emerging markets, into India. Is it improving? Because at least for us, it seems like FII figures have been finally coming back.
Yes, so dedicated India funds have never left. They've been getting steady inflows, nearly over $500 million nearly every week, and have been since the middle of last year. The issue for India, certainly from a fund perspective, has been that the global emerging markets funds, the big diversified funds, even as they've raised their average allocation to India to a new record high, have not been attracting much money, if at all. So that source of flows has really dried up or even gone into reverse for much of the past 5-6 months.
Great to have you on the show and give us that perspective. Let's just quickly